The market pulled back last week, but investors may be focused on the wrong story. The S&P 500 declined 1.4% last week, while the NASDAQ 100 fell 2.3% as technology stocks faced additional pressure. Despite the pullback, the S&P 500 remains up nearly 13% for the year. So the bigger question isn't what happened last week. It's whether cracks are beginning to form beneath the surface of the economy. I'm Eric Pettway, Chief Investment Officer at Journey Advisor Group, and this is CIO Corner. We'll start with the markets. While U.S. stocks struggled last week, international markets held up better, continuing a trend that persisted much of the year. It's a good reminder that market leadership changes and diversification can matter when it does. This week, investors will be watching developments that could influence inflation, energy prices, and interest rates. The Federal Reserve's Jackson Hole Symposium will also be in focus as markets look for clues about the path of monetary policy. Why does that matter? Because interest rate expectations affect everything from bond yields and borrowing costs to stock valuations and investor sentiment. But the more interesting story right now may be the U.S. consumer. That brings us to our chart of the week. Consumer debt remains near record levels. According to the New York Fed, total household debt stood at approximately $18.8 trillion during the second quarter. Credit card balances remain above $1.2 trillion. Auto loans exceed $1.7 trillion, and student debt remains elevated as well. Those numbers alone don't tell us whether consumers are healthy or unhealthy. What matters is how consumers are handling those obligations. And that's where things get interesting. Recent data suggests some households are feeling pressure. Retail sales fell 0.6% in July, coming in weaker than expected. At the same time, the personal savings rate recently fell to just 2.7%, well below historical averages. Consumer sentiment also remains near historical low levels. Taken together, these figures suggest many households are still feeling the effects of higher prices and borrowing costs. But before we jump to conclusions, there's another side to the story. The overall economy is still growing, which is why some of the data can appear contradictory. The simplest way to think about it is that there are really two consumers in today's economy. Some households continue to benefit from stable employment, rising asset values, and strong incomes. Others are facing higher debt payments, limited savings, and budgets that feel increasingly stretched. Both realities can exist at the same time, which helps explain why the stock market can perform well while consumer sentiment remains relatively weak. It's also why broad economic headlines don't always reflect what individual families are experiencing. We're also watching the relationship between wages and inflation. Recent data shows wage growth is now running at roughly the same pace as inflation. That means many workers are no longer seeing the purchasing power gains they enjoyed when wage growth was running well ahead of inflation. For investors, the key takeaway is not that a recession is inevitable or that markets are headed in one direction or another. It's that consumer strength remains one of the most important drivers of the economy, and right now the picture is mixed. As we move through the remainder of the year, we'll continue to watch employment trends, consumer spending, inflation, Federal Reserve policy, and corporate earnings for clues about where the economy may be headed next. For long-term investors, periods like this are a reminder that reacting to every headline is really a sound investment strategy. Instead, it's important to stay focused on your goals, your time horizon, and the financial plan is designed to help you navigate changing market environments. Thank you for spending a few minutes with us today. If you find these market updates helpful, follow Journey Advisor Group on LinkedIn or subscribe to our YouTube channel. As always, remain calm, stay focused, and most importantly, stay the course.